I.U.L is far superior to whole life, in my opinion. In this episode, I'm going to address the question, is whole life insurance a good investment for retirement? Well, get ready to understand that the financial services industry will not allow insurance to be regarded as an investment. Whole life is better than most IRAs and 401ks out there, but it's only a good way to go. It wasn't designed for retirement income. I.U.L was designed to give you the highest amount of net spendable retirement income totally tax-free. So get ready to learn. So first of all, let's talk about the features of whole life insurance. I have a little ditty that maybe you've heard me say on other YouTube videos that goes good, better, best. Never let it rest. Never let it rest till good gets better and better gets best. Now, I think whole life insurance can be a good way to go, provided that your primary objective is a death benefit. You're insuring yourself in case you were to pass away with an untimely death or what have you, and you want to make sure you have this death benefit. Whole life insurance was usually designed to have some guarantees in there that are not free. You have to pay for it, and so it's more expensive to make sure that that life insurance is in force your whole life. That's why it's called that. If you live to be 75, 95, 120. And so it's going to be more expensive. So whole life was primarily designed for death benefit. Now you can access cash value out of there on a tax-favored basis because money inside of life insurance has been this sacred cow for over 100 years in the Internal Revenue Code. In Section 72E, money inside of an insurance policy growing with interest or dividends or whatever will grow tax-free. If you need to access money while you're alive, you can access money up to your basis tax-free if you withdraw it, or you can borrow, and the insurance company charges you an interest rate to borrow your money, but your money still earns usually an interest rate equal to or greater than what they're charging you to borrow the money. So a lot of times whole life is used for what is called the bank on yourself or infinite banking concept, where you're borrowing and paying yourself back interest, or you're borrowing money at, let's say, 4% and they keep crediting you 6%. So it's okay, but whole life was never really designed to give you the best net spendable tax-free income. It can give you income, but if you ask most whole life insurance agents to illustrate the type of income that you can pull out of a whole life policy and never run out of money till age 120, they have a hard time doing it. And if you're lucky, on every $1 million that you accumulate in the policy, you'd be lucky to be able to get $30,000 or $40,000 a year of income, maybe $50,000. If you had a super performing whole life policy, maybe $60,000 out of $1 million. But the problem is the insurance company would have to be earning 8, and they're not doing that. Most whole life companies are not crediting that much in dividends, but that's about as high as they got. If you did earn 8, you'd only be netting 6. I love indexed universal life because the last 25 years, I've earned 11.17 and I've netted 10.07. I earn 11 and net 10. In a whole life policy, at best, you might earn 8 to net 6. And it would take you till age 95 before you finally got within that 2 percentage point spread, earning 8 to net 6. I can earn 11 and net 10 within 10 or 15 years with an indexed universal life because the insurance costs get less as you get older. Did you hear that? So stay with me. I'm going to tell you why with a properly structured indexed universal life, the insurance can become cheaper as you get older. I would say that the biggest difference between whole life insurance and why it's not the best instrument if you're trying to accumulate money tax-free for retirement, but I.U.L, Indexed Universal Life, is because of flexibility. You know, if you get to know me, I have this beatitude. Blessed are the flexible, for they shall not be bent out of shape. And so I like universal life because it's far more flexible. Whole life requires that you must pay a set premium in order to make sure that it doesn't lapse. So with index universal life, I can structure it to accommodate, let's say, 100,000, 300,000. Do I have to put that much in? No. I could put in 10,000. If I put in 100,000, I could probably coast for 10 years without adding a dime. You can't do that with whole life insurance. So I have all kinds of flexibility. But if I could put in 300,000 and I only put in 30,000, I can put in the additional 270,000 anytime in the future because I'm grandfathered with a lot more room with indexed universal life. So I like the flexibility that universal life offers. Now, when we talk about the differences here, whole life insurance can usually generate a rate of return unless you buy variable whole life, because there's fixed and there's variable. In universal life, there's indexed. Well, whole life insurance, if you put it out to the market, then you can lose money and have to cough up a whole bunch of premiums to make sure it doesn't lapse because the cash values were depleted if the market dropped 40%. I've never owned a variable product, a variable annuity. I've never owned a variable whole life or a variable universal life. I like indexed universal life. Indexing allows me to make money when the market goes up and not lose when the market goes down. But the neatest thing about universal life is when E.F. Hutton, who was not an insurance company, they were a brokerage firm, came out with the idea. They said, hey, why don't we take the least amount of insurance the IRS will let us get away with and put in the most premium and self-insure? So if I wanted to drop in $500,000, let's say, into an indexed universal life policy, I may have to spread it out over 4 years in one day to grandfather tax-free access for the rest of my life. But when I put in $500,000, age 60, let's say, the minimum death benefit is $1.2 million approximately. Well, people say, golly, I could buy way more life insurance than $1.2 million. Well, that's not your objective usually with indexed universal life. You want to self-insure. You put in $500,000 at age 60, you have $1,200,000 of death benefit. Well, now the insurance company is only at risk for the remaining $750,000 because $500,000 of that is your own money. You've self-insured for that. So they only charge you for the difference. In 10 years, at 7.2%, which is the lowest average that I've earned in the worst decade since the Great Depression, $500,000 doubles to $1 million in 10 years. Well, now the insurance company is only charging you for $200,000 of the $1 million too, because $1 million of it is your own money. Do the math. Usually within 10, 12, 15 years, the death benefit is less than your cash. And so the death benefit now just keeps ahead of your money. You've self-insured. And they're only charging you for about a 5% difference. If it doubles from $1 million to $2 million, the minimum death benefit under IRS rules would be $2.1 million. They're only charging you for $100,000. That drains out less than usually 1/10% of the interest I'm earning on my $2 million. So the older I get, the cheaper it becomes. Right now, if I earned 11% like I've been earning, I would be netting probably 10.9. Whereas during the early years, if I earned 11, I only netted 10. Oh, I only netted 10? Whole life takes until you're 95 years old to maybe earn 8 and net 6. I would rather earn 11 and net 10 because the cost of insurance is really not a cost to me. It's paid for out of a minuscule portion of money that most people would shell out in taxes if they save for retirement in traditional IRAs and 401ks. So what are the greatest takeaways here? Is whole life a good investment for retirement? Well, it was never really designed to be used to create predictable retirement income that will last as long as you do. It was designed more for death benefit. Indexed universal life was designed for living benefits. And so that's why a properly structured indexed universal life will allow you to grow your cash to a larger sum quicker. When you get $1 million, instead of whole life only being able to generate maybe 40, 50, or 60,000 a year of income at best, $1 million nest egg in a universal life that's indexed would generate between 80 to 100,000 a year of income. So it's usually twice as much income that can come out of an indexed universal life that will last because you're self-insuring. The costs are very low if you live to be 120. I love the flexibility. I love options and the ability to put in a lot of money at times and not have to put in anything. You don't have that flexibility with whole life insurance. So indexed universal life is my favorite. It was designed for tax-free retirement income. There are a lot of benefits that come along when you understand how to use it for maybe business, for working capital, for college funding. It's not just for the death benefit. On that last point, when I ask a room full of people, what are some uses for baking soda? And it's usually the women that will say, well, you can use it to soak in a tub. You can take the odor out of the food or in the refrigerator. It'll take the pop out of a pot of beans. They give me all these uses for baking soda. And then finally somebody goes, oh, it's good for baking. The obvious, okay? See, life insurance is for life, not just death. But most insurance agents, most financial advisors only use it for death, and it's named life insurance. So I like the living benefits. So my favorite vehicle is a max-funded indexed universal life. I call it the Laser Fund. In fact, it's a title of my 11th book, The Laser Fund. These have been flying off of our warehouse shelves. I want to gift you a free copy of this book. It's 300 pages. There are all kinds of charts, graphs, and explanations. You turn the book over, and this actually has 62 client stories that will help you understand how the Laser Fund, Indexed Universal Life, can be used for all kinds of financial goals. So all you have to do is go to Laser Fund, L-A-S-E-R, laserfund.com. I'll buy the book for you. You just pay $5.95 shipping and handling. I'll fire you out a hard copy, or there's options there if you want a digital version or audio version too. But I want you to become empowered and know why this is the best alternative. In my opinion, it knocks the socks off of whole life insurance for retirement goals.